The following is paid programming. Welcome to Something More with Chris Boyd, certified financial planner practitioner and founder of Asset Management Resources, LLC, a registered investment advisor firm. We call it Something More because we like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients across the country, your host, J. Christopher Boyd.
Welcome. This is Something More with Chris Boyd. I'm Chris Boyd, certified financial planner practitioner. My office is Asset Management Resources. We're a registered investment advisor firm. Thanks for being with us. Our show, Something More, is a financial show. We call it Something More because we like to talk about not only those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Joining me throughout the show, I've got Jeff Perry. How are you, Jeff?
I'm doing great. Thanks for having me with you again this week.
It's good to be with you. And I know I'm here on Cape Cod, but you're down in Florida. How have you been faring up with all this weather we've been hearing about in the news?
I appreciate the question. So we are far, far away from where the hurricane went through earlier this week. We are in southeast Florida in Port St. Lucie, known as the Treasure Coast. So between Vero Beach and West Palm Beach on the East Coast. So the hurricane hit in the Big Bend area and went across the state. So we had some thunderstorms, like as the hurricane was coming up into the Gulf, the storms, went across the state. So we had thunder and, the bands, I guess as they call it. But other than that, we would not have known there was a hurricane out there.
I got to say, it felt like the Weather Channel was on the news a lot this week. And I kept going, all right, which news channel is not talking about the weather?
Yeah.
People
know that we are here, but they don't know where we are. So whenever there's a storm, everyone assumes that we're in the middle of it. So I appreciate people asking, but no impact on us this time around anyway.
Excellent. Well, this week we thought we'd sort of jump in with some review of what's been happening in the economy and in the markets, some recent economic data worth talking about.
I still think that the Federal Reserve, and people probably saw that in the news a lot last week or the week before with the Jackson Hole conference and certainly Chairman Powell was there, and anybody who's anybody in the in that sector of the economy was there, and I think we're still a big deal. Yep, everybody waiting for his words. What's he gonna say? Interest rates the same. When will they be lowered? Any more rises, increases, all that. So, but I'm saying that just because I think we're still in this. The market is what I'm talking about. The market is still hanging on, every little comment or every little suggestion that the Fed makes regarding interest rates. And I still think regarding the news cycle in the market, I still think we're in the time of bad or slower economic news is good market news.
Isn't that funny? Yeah.
It's not something that, it's not intuitive. You see. Like this past week, we had a couple of interesting things. The ADP weekly job report came out, and it was expecting that the U.S. economy in the private sector, not in government, ADP doesn't measure the government jobs anymore, but in the private sector, the prediction was 200,000 new jobs. And that number has been declining as well, but that was the projection, and it came out at 177,000. So, if you're looking at it just as how's the economy doing, you're saying, well, that's not a terrible number. It's a positive number, but it's below expectations. Perhaps the market might be a little bit worried. And it initially, anyway, it had kind of the opposite result where the market said, oh, that's good. And why is it good? Because they're thinking that the Fed won't have to continue to raise interest rates, and higher interest rates do scare the market long term if they are sustained.
Yeah, good point. So on the one hand, fewer new jobs. On the other hand, not so much a worry that the economy is heating up still and growing too fast and that sort of thing, and
Right.
creating inflation.
Inflation, right? That's the big fear out there. And are we going to have a soft landing? Meaning, is the Fed going to be able to coordinate with their interest rates and the things that they do with bonds, et cetera, and money supply? Are they going to be able to have this landing back to normal growth and normal inflation without having any real recession or anything that's drastic? And there was another sign this week, Chris. The GDP, the gross domestic product of the United States, for the second quarter, so the quarter that ended in June, has gone through the review process. And the initial report was it grew annualized 2.4%.
Mm-hmm.
However, the revision is now 2.1%, or 0.3 slower. And even the core PCE, which had gone up in the initial report 3.8%, went down 0.1% at 3.7. So a little bit slower than we thought. So there we go again. A little bit of maybe concern. Economic news is maybe good market news. Time will tell long term, but at least that was the initial reaction from the markets after those data points came out.
Well, it's interesting because we've had since October really a nice run up in the markets, but thinking in terms of the S&P 500 or whatever it might be,
broad market,
broader market, more concentrated in the Nasdaq and the tech heavy names and some of the big names that really are the top holdings in a lot of these indices, maybe more so in the Nasdaq. We've seen some really good returns from them over the last year to date, or roughly the last year, it's at least since October lows, where I'm not sure exactly, but we're up some. I say on the S&P 500, I got to say at least 25%, something like
from
that,
the lows, right?
The lows, and year to date, I'm not sure. Do you know what it is, Jeff?
It was last I looked, it was around 18%.
Yeah, around there. So, and and the Nasdaq was more exaggerated as an index. So the more growth oriented had bigger upside to recover from the bigger downside last year.
Right.
The more value side of the spectrum has been, less robust, and but it didn't go down as much last year either. So, in any case, these names at the top seem to be really driving things, and we saw it, really over the last month. Certainly for part of the month of August, we've seen a decline, some stocks decline about 5% from the start of the month at one point, but now it's recovered a lot of that in the last few weeks, the last week or so.
I thought that
some of this news that people are, maybe it's not a worry as much.
Well, I thought going into the August, which is typically a slow month. I guess we should say that it's typically a slow month when you're looking at volume, the number of shares being traded, a lot of people on vacation on Wall Street and all that. So tough to draw any long-term conclusions.
It does tend to create more volatility. It's like very commonly a more volatile month, in part because of that reduced volume.
I was watching our friend Jeremy Siegel. I know he's been a guest on the show before, but he's just one of
like him.
Yeah. So he's a professor emeritus, I guess, now at the Wharton School, University of Pennsylvania, and he just was a well thought of, respected market commentator as well. He was talking about the fact that historically September had been a difficult month for the market. Just there's a lot of events over market history. There was a paper that he was referencing. I don't remember the name of it now, but basically ever since that paper came out and said September is a rough month for the market, August has been a rough month for the market.
That's funny. Yeah.
Meaning,
so it was a little early, huh? Yeah.
Well, if you know something, if you feel that something bad may happen in September, you may make a trade. You may sell off a position in August. And so his general commentary wasn't trying to time the market, but he was just saying when things become known, they're almost false at that point because
Yeah.
people respond to things that they believe are going to repeat themselves. So whether that be a rough September or a end of the year Santa Claus rally, as they call it. So
Yeah.
um, so back to what I was going to say, I had thought when the market was giving back some of the gains from this year in especially in the tech sector, that was kind of a normal just change in the economy. With higher interest rates, technology stocks typically don't do as well because a lot of them rely on borrowing, et
Yeah.
cetera. Not the Apples of the
Growth.
world.
They're more
Right.
growth focused, and
Right.
there's
So
cost in that.
I thought that was kind of a normal revision that was relevant to the economic situations. But then we saw this, like, all of a sudden the market woke up and said, hey, what's AI? Right.
Yeah.
And some great NVIDIA earnings that came out. They're the chip
Yeah.
maker.
That was huge, right? Did we talk about that last week? I don't remember.
I think we did touch on it. We
Yeah,
they beat their top line by a couple billion with a B
that's right.
dollars on their estimates. The stock didn't really run because of it, interestingly enough.
Well, it's already been up,
Right,
soaring,
right.
in relative terms. I mean, I forget how much of a multiple
Oh,
it
it's
is,
a
but it's
great
enormously higher as, it's not, it's hundreds of percent, I think, type of
it
thing.
is, yeah.
So
It's
a multiple of where it was, I mean, multiple times growth. Um, but things like that have led to a sense that the market's a little bit o- overextended in a sense, or at least parts of it that
I,
valuations seem rich.
I like the word frothy.
Okay, there you go. I like it.
Yeah, just a
So
little rich, a little bit exaggerated, extended, whatever adjective you want to use.
yeah, I know we've talked about the idea that PE ratios aren't always the best measure of trying to quantify these
Sure.
kind of issues, but there is a sense that um, the PEs have gotten a little bit lofty, but they've come back some in part because of this you know decline we had during the month, and then some good earnings help uh, make the earnings higher. The price to earnings doesn't seem as off, right? So
That's one part of it that the prognosticators, the talking heads on a lot of these financial shows, were just dead wrong on predicting the earnings of well established and successful companies. They were predicting that the earnings wouldn't hold up, and I won't say all, but I'll say many of
yeah.
the companies that reported earnings in this latest quarter, as well as the second quarter, have done quite well.
We've talked about this guide to the markets that JP Morgan puts
Right.
out. They update it all the time. And one of the things that's interesting is relative to the 20-year average price to earnings ratio forward looking, um, it looks like when it comes to large company stocks,
Hmm.
uh, value stocks look to be kind of in line with their long term average PE, but growth stocks look to be ahead of their average sort of price to earnings ratio. So, it gives you a sense that either those earnings have to keep growing to justify that
Right.
that higher price, or we're in need of some. We're not in need of. We're likely to see some give back, or we're just going to be here where we are for a while until earnings do justify it.
Yeah,
That.
I think you're absolutely correct. I think there's something else at play here that doesn't get a lot of talk. Is a lot of people purchase value stocks for the dividend,
Yeah,
right?
yeah,
And as we've seen increases in interest rates, you know, that makes it as simple as opening a money market account to get 4.5%, 5%.
yeah.
FDIC insured in most cases, or many cases
Oh,
anyway.
yeah, yeah. You can get a
And
CD for that
CD,
kind of number.
CD rates are up. Um, if you're a short-term investor, you can get 5% in a treasury. So there's lots of places to get some yield. So I think it's normal that people who are interested in taking some risk off the table and getting, a decent return on their cash, who otherwise might be looking for yield, they're not looking at the value stocks or hadn't been looking at the value stocks. And I think that could be also attributed to their out of favor status, if you will. But
Yeah. For a long time, right? Growth has been
right,
outperforming value significantly over the last 5-10 years, probably.
right,
Last year was an exception to that when markets were in decline, that value stocks held up better. And but over a longer period of time, growth stocks have outperformed. So there's sort of maybe a recency bias. Is that where you're going with that? That
right.
people think in terms of, well, that's the way it's going to continue to be, and that's not always the way it actually works.
That's right.
I think this is a theme Brian touched on. Sort of a transitioning in our prior quarterly.
Brian
uh,
Regan, our chief
Brian Regan,
investment officer. Yeah.
on our economic and market outlook webinar, where he was talking about introducing some dividend paying stocks and maybe curbing some of our exposure to um, the mega cap growth names that we have. Not to say that this is an all in, all out kind of thing. I think it's more he's been dealing with it more incrementally. But I do think that's a theme that's worth paying attention to.
I agree.
As you're talking about this, I agree that um, it seems like there's some cheaper valuations. Basically, it's
Right.
an attractive price. Similarly, small company stocks seem, particularly on the value side, seem to be more attractively priced.
Mhm.
There's more room for opportunity. People talk about international funds. We had on, I forget now who the guest from from Schwab.
Yeah, I don't think I was on that week.
Forgive me. Anyway, his point was international exposure was a good value right now.
Back to the interest rates. So all this plays in my mind is your long term or your longer term.
Klein top.
At least you didn't have to wait till 2 a.m. for that to come.
Yeah. Jeffrey Kleintop. Sorry about that. Anyway,
I was saying it. If you think about interest rates, and you think about their longer term direction, so
yeah,
the Fed is near the end of their tightening, their increases in interest rates, and if interest rates after the inflation scare is passed completely, and the Fed starts to reduce interest rates a little bit to get back down to a more normal situation.
I don't know.
We don't know when that is, but I think that's a favorable long-term positive for the equity market.
For the equity markets generally, I do.
Right.
I mean, it does seem like that would favor more if we're in a falling interest rate environment, which it's not today.
Right.
But that might favor the growth names more. To your point about cost of capital and things like that.
Oh, interesting. Yep, sure. It also favors people looking for dividends going into the value sector.
Ah, good point. Yeah.
If that's where I was going. If they remain at the current valuations, there seems to be more and more attention given to this discussion we've been having about value stocks for a couple of months now. But if people are looking for yield, there's only so many places to go. So
yeah, and as you know, as our listeners who listen to us regularly, we don't really advise investing on the basis of yield per se. We like to invest for total return, and that doesn't mean that there isn't a place for companies with yield. If you can get a company that's reasonably priced, paying a nice cash flow, and you can just bring in that dividend, certainly appealing when it's attractive and there's a good valuation to the company. But you know what I'm saying? We like to look at it in a holistic way. It doesn't do us any good to get a big juicy dividend and have that stock decline in price.
correct.
That
Correct.
kind of. So it's looking at it in combination. And for us, whether it comes from dividends that we realize are benefit or whether it comes from price appreciation, we're kind of agnostic. It's wherever we get the opportunity, and different moments in time will lend themselves to different options of those, which will be more attractive. For a big picture for most investors, you want to have exposure in more than one. You don't want to just be growth tilted, as an example. You want to be nimble enough that you can maneuver if you're looking to maneuver, where you have some ability to shift that balance,
Right.
or at the very least have exposure in both growth and value kind of positions. And we do find sometimes people have a tendency to gravitate toward what they like and what they know, and that can create an overweight, particularly if they've had good results from something, that they can get overweight in that um, space just by virtue of the growth it's seen, and not rebalance from time to time. These are all, things that are important to do
Yeah.
in the way we handle our investments.
Yeah, you can't chase the latest trend because the latest trend's just about over before you recognize it's there.
Yeah.
I mean,
So
back to
back to
the
the latest
Nvidia.
trends.
Right.
Yeah. Yeah. Good
Yeah.
thought. Yeah. Let's go back to that. We were talking about artificial intelligence, NVIDIA. Yeah. You were going to bring up that article.
Sure. Yeah. So as part of AI, not just NVIDIA and semiconductors, but there's a lot of discussion on what are the best ways to use AI, right? How does AI improve our life? And we had David Sampson on last week, who's a cyber security expert, talking about some of the scary stuff of AI
Yeah.
and what it can do. But certainly in our own sector of financial services and financial asset management or financial planning, AI has been around a little bit. What's the term? Robotic investing or robo investing has been there.
Yeah.
It hasn't caught on fire because it's of the the danger, I guess, of trusting a bot to give you long-term financial advice.
Yeah,
But
it's really programming, and that's fine. But there are some nuances that sometimes maybe it may be more broadly structured and not as nuanced at times.
yeah, I
And
guess
I think the reason it hasn't caught on for most instances is there are times when an actual person can provide advice that's enhanced value.
well, that
Uh,
was the subject of a Fortune magazine article. The title of the
I did
article,
see this article. It was good.
it was by Corianne Hicks and just published a couple of days ago. It says, I pitted GPT against a real financial advisor to help me save for retirement, and the winner is clear. They're very good at writing headlines lately, by the way.
Yeah, yeah.
You know,
Well, it
you
was funny because it sounded like she was going to be favoring the Chat GPT, but I didn't get the sense that's where it ended up. Did you?
not at all. I mean, she gave credit to the AI technology and that it's quicker.
Yeah, it
if
was
you put raw
quicker.
facts
And
in, right?
if you were looking for education or information, it sounded like that was a good resource to kind of find the information pretty quickly.
You know what all this reminds me of? Not to go off on a tangent, but
Oh,
some of the websites and services out there for diagnosing your own medical care.
yeah.
Like, I have a sore throat, my left knee hurts, and my fingernails black.
What does this all mean? Yeah. Oh my God, I'm dying of cancer. Yeah.
Right.
Yeah.
So, I mean,
Doesn't that always happen when you look at those
oh,
things? You're like, oh,
I,
uh-oh,
I've
I'm terrible.
diagnosed myself a few times, and I've always been wrong. So
Yeah,
I've given
fortunately,
up.
right?
But it's the same. It's the same. Not the exact same principle, but it's to get an answer from the AI. You put in data. You answer questions about yourself and your goals and all that. And that's where I think it falls apart. It gives you quick answers, it gives you quick calculations, but I use Quicken for my personal finance at home. Quicken's been doing all that for a long time. I can fill out blocks on a form and get projections, right?
Yes.
But to me, and what the article focused on at the end was the financial advisor wins because they ask questions.
Yeah. They know the questions to ask in a way that isn't happening with the automated process. And out of that comes additional observations and recommendations,
I mean,
right?
yes. How many times have you sat with a client? This is rhetorical, obviously, but how many times have you sat with a client and all the paperwork that they filled out, the questionnaire, the things you know about them, the conversation you had on the phone, and when you're going through their personal financial situation, something comes up that is significant, major, that just didn't make it into the blank.
Yeah, or people come in with a determined priority set where they think this is what I really am here to talk about. And as we engage and discuss, we realize, hey, this is also very important. Maybe we need to step back before we, and oftentimes it's like, what's my strategy for portfolio design? But sometimes it can be, gee, we really probably should have more liquidity reserve, or, I don't know,
Right.
you get, as an example,
Right.
something else because of circumstances that may be envisioned.
I know we're
address that.
I know we're planning a future segment episode on longevity and all that, but
Yeah.
you find out during your conversation with someone that their 8 closest older relatives have lived to 105.
Yeah.
And
that might be relevant in their planning.
That's right. Or sometimes people don't share the opposite stuff. Well, I do have a medical condition and I probably, won't live a long time. That doesn't show up on a form somewhere. It shows up in a personal one-on-one conversation with someone you trust.
Right.
In a private room that's not being put in some insurance database online.
Right.
That's what everybody's worried about, right? And if I say I have this chronic disease on this form online, I'll never. Right. Yeah. Right. So it's those things that you can't measure, in some uniform way, that really give the value to dealing with someone who has your best interest at heart and who knows a lot about you. It's like your relationship with a doctor versus, WebMD, or your relationship with your lawyer rather than buying forms at Staples.
By no means is this the finish line of this process.
No.
Right? This will evolve and improve, and there'll be enhancements in how it works. But I think for our listeners, as we start to wind down this segment, think about this. I would say that AI is a tool that advisors and clients can use as a resource, perhaps with education and that kind of thing. And if that's helpful, great. At the same time, there's still a great deal of value in having the opportunity to have one-on-one interactions in the process.
Well
and
said.
So, what's that?
Well said.
Yeah, thanks. So as we wind down, I want to just remind everybody, if you have a need for help in thinking about perspective on the markets, or what elements of the portfolio design to include, or other aspects of your financial planning, if you're going to live to 105.
That's relevant.
Yeah. So if we can be of help in that process, don't hesitate to reach out. We're available to you through our website, amrfinancial.com, or toll free 866-771-8901. Until next time, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's financial planning, portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at amrfinancial.com or call us toll free at 866-771-8901, or send us your questions to radio@amrfinancial.com.
You're listening to Something More with Chris Boyd, Financial Talk Show.
Asset Management Resources LLC and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.